and which will cover angel capital and venture capital in main criteria. But along with that, we will also try to address the requirement of the capital in a startup or the funding requirement in a startup at the different time and durations. So if you look at that, what startup funding includes in itself, so you can understand in a startup case, we have mainly three type of sources of fund, which usually we try to use in our startup of any particular concept. First, very important thing which is there as an angel capital. Angel capital is usually the own capital of people who try to become angel for any startup, or the entrepreneur who do have the idea, a strong idea, but do not have money. So someone comes as an angel and give you money without asking any question, without any if and but. So that is angel capital. Venture capital is basically the capital pooled up by the private investors. So the term itself includes the investor. It means they are interested, to invest money. So they will see return. And since they will see return, it means they will look at that startup must be having in that stage where they can get return. In case of angel capital, as angel word itself indicates, that it is kind of thing which do not ask you question, return, if and buts. So there is a fundamental difference between angel capital and venture capital, and the sources are also different. Here it is owned capital, you invest from your own pocket. Here the investor come into pool up money fund, and then that fund is invested into startup fund. So as a venture capitalist, the role of venture capitalist is to collect money from private investors and to invest in suitable startup. That is the main work. And the third type of capital which is required by the startup is public capital. This capital is required when your startup becomes successful, and then you can go to public. So when you can go to public capital, when your startup is already on floor and it has given you some positive results. But before that, you need angel capital and venture capital. Now what type of different, what is this angel capital? If you look at that, angel capital is a capital that a startup procure from angel investors which can be termed as an angel. The idea of taking angel capital is when you want to convert your idea into prototype. Now look at this thing is very important to learn. When you need to convert your idea into prototype, then you need angel capital, whereas the venture capital is not required at this stage. Who are these angel investors? Angel investors are usually private investors who take high risk of investing. Now look at high risk as compared to venture investors, venture capitalist. Typically in exchange of ownership equity or creditorship security in the company. Usually they invest, either they take ownership equity, that means shares, or they take creditorship security in form of any bond or debentures. Sources of fund, you know that this angels investors own capital. It is not from collected pooled amount. Angel investors are also called as seed investors because they plant seed into your business. Private investors, informal investors, prominently they are business angels. They give you money when whole world is not having faith in you, and that is why they are called as an angel. Angel investors usually invest their own money. They do not take money from bank, they do not take money from money lender, they do not arrange money from somewhere, but their own pocket money. As you know that startup, they invest at the stage where idea is to be converted into prototype. Now you can understand what is the success rate, usually success rate at this stage when idea is converted into prototype. The data says that 70-80% ideas are not converting into successful venture. So it means there is a very strong rate of rejection, failure, and that is why this duration is called, this stage is called death valley curve stage in startup. So this is very important to understand. I believe that you must look at these things. Death valley curve stage, we'll discuss with the curve also. Angel investors are usually high net worth individuals who find startup more appealing, potential and predatory than others. More appealing, more potential. Now look at the venture capital. What is venture capital? Venture capital is basically capital that a startup procure from venture capitalist. It is usually common in form of VC fund. That means private investor pool up fund into venture capital fund, and then fund is invested into somewhere, some startup. When you need this capital requirement, venture capital requirement is at the time of venturing into business. That is when prototype gets success and commercial production starts. This when is very important. Angel capital, you need to convert your idea into prototype, and this venture capital is the next stage requirement. So if you put your venture capital at the age or at the stage of angel capital, then it will be wrong, because the interest, aim, objective of the venture capitalist is entirely different than the aim, objective of the angel investors. Now venture capitalists are basically the private investors like angel, but they are not taking that much risk which an angel investor take, and they invest in high growth potential firms. That means those startups which have already shown high growth potential, and this high growth potential can be shown only after conversion of testing of prototype. Once prototype becomes successful, it means you can expect a high growth potential in that, and then you invest. That is means to some extent you have less risk as compared to angel investor, and it is invested to in the firms which do not have access to public equity. That means they cannot go to issue shares, they cannot take loan from bank, or other any debt instrument is not available. Usually you can understand that pooled fund is there, well of investors, investment banks or financial institutions. Venture capitalists are the private equity investors till company becomes eligible for public equity subscription. That means venture capital remain in the company till the company is not will become eligible for public equity. That means issuing shares. Venture capitalists buy a stack in entrepreneur's idea, nurture it for short period time, and then exit with the help of investment bankers at right time. Now look at angel investor, venture capitalist and investment bankers. You can understand these three very important concepts of funding or finance. Most of the time investment banker is being very much known to you. You talk about that you want to become investment banker. Now what does it mean? It means that you are talking about the third stage of any business. First stage of investment is angel investment. Second stage is venture capital investment. venture investment. And third stage is investment banker. Investment banker means investment in those firms which have already shown their success trajectory and they have become eligible for public equity. Because investment bank means you look at that which company is good potential holder and you should invest in shares, bonds, debentures. So venture capital is usually the high growth potential firms for the investment. Venture capitalists enter after seed funding. That means angel investment round. When angel investor exit, then venture capital enters. When venture capital exit, then investment banker enters. So these three concepts must be very clear, fundamental concepts of investment. Now, looking at the different stages in startup funding and fund requirement and different stages, you can understand the three stages of any startup. First stage is called incubation stage. Second stage is called growth stage. And third stage is called maturity stage. Obviously, if you look at the life cycle of any particular product or business, then fourth stage will be a decline stage, which will go after this line like this decline. So my concern is in a startup to discuss about the first three stages, especially two stages. So you can understand that the stage of incubation is the stage till you are not achieving break even. That means you are not achieving break even means no profit, no loss. So this must be very clear to understand. And this is incubation zone, right? When you incubate idea, develop prototype, then go to commercial production, and once you achieve the break even, then it becomes very easy to understand that what would be the growth of this particular idea. Initially it may be slow growth, but this increases and crosses a limit where your startup become eligible for public funding. So this stage is also called as, why this curve is in negative direction and negative color also, and it is not in red color, it is red color. Why it is red? Because it is valley of death. We have discussed during this period you do not earn any profit, your investment is always in loss. So it is, your idea may go to death, lead to death. And during this, whatever fund, look at angel capital, seed capital, accelerators investment, whatever is there. So this is very high risk zone. And as compared to this is low risk zone because you have already achieved break even. Now look at why there is a gap. Why I say there is a gap. Reason being is that there is a difference in achieving no profit, no loss position. Look at when your investment returns back, this exactly break even is just on the line when you start earning profit. And when we talk about the growth, it means you are entering into positive zone, you are not in negative zone. And in positive zone there is a role of venture capital, strategic alliance, acquisition, merger. Sometimes startup when achieve break even is usually acquired by big companies or merge with another company, or they become a strategic alliance with some big company, or if not, then the venture capital come into picture as an investment. So acquisition, merger is also one of the source of funding. Strategic alliance also open source for your investment. venture capital also come in form of investment. So fundamentally, you can understand the angel capital versus venture capital. Angel capital usually enter into your negative zone of stage, where venture capital is entering into when you are in comfortable position. And this equity crowdfunding and crowd lending, this enters either in the incubation stage or in the growth stage. It is possible for initial stage also and in the growth stage also. And this maturity stage, once you become eligible for public funding, you are having public capital in form of share, debenture, preference share, equity shares, bonds, bank loan, bank credit, term loan. So many options is there. So options are there for your public capital funding. So my point is to make you understand that look, these things are very clear. Seed capital is not the venture capital. Angel capital is not the venture capital. Angel capital is required when you are in the death valley curve. Whereas venture capital is required when you have achieved break even or you are about to achieve break even, right? So then venture capital take entry into that, because venture capitals usually they keep on monitoring startups right from the death valley curve, and then see and they analyze, evaluate that what is the potential in this business. And as soon as they see that yes, they have converted prototype into commercial production and they have shown a very strong potential of growth, then immediately they take entry into that. And it is very clear. This picture is a picture which gives you the fundamentally the stages versus funding requirement. So I hope that venture capital and the angel capital and the other type of startup funding must be clear to you at this stage. And this is all about that I was interested to discuss today. Your questions are always invited on classroom page. So uh, let us see your questions.